Calculate the stock price for MTY Food Group, and we're going to do that using prior financial information. Now the first step is we need a market cap, which is 621.5 million, and the stock price of 24.79. So now we know the shares outstanding because it's just a market cap divided by the stock price, and so they have 25 million shares outstanding. Next we need free cash flow. And the best way to calculate the value for a company is to estimate future free cash flow and discount those numbers back to today's dollars. And that's pretty much what we're doing in this video. Okay, and next is net income, and we need 4 years of that, and that's on the income statement. That's just a profit and loss for each year. And last is revenue. So you can see they had a nice increase in revenue in 2019. That's a good sign. The revenue increased each year pretty consistently. Net income, it did increase in 2018 but dropped back in 2019. Next we need to look at the capital structure of MTY and figure out the discount rate we need to apply to future cash flows. So the interest on the debt is 17 million. And let's go to the balance sheet to find the debt. And the current debt, that's 4.6 million, that's due within 1 year. And the long-term debt is due after 1 year. That's $500 million. So they pay 3.26% interest on the debt. But interest payments are tax deductible. So let's get their effective tax rate. So the income before tax is 97 million, and the income tax is 20 million. So the tax rate is 21%. So the cost of debt is 2.6%, and they have a decent amount of debt. 47% of the capital structure is debt. Now we need to find the cost of equity, and we need a beta for that. And the beta is 1.78. That's the volatility of the stock, how it moves relative to the market. And the cost of equity is 16%, which is a lot higher than the cost of debt. Because equity is more expensive than debt because equity sits lower in the capital structure of a company. In the event of a default, debt holders are paid before equity holders. And this number, 9.76%, is the price MTY pays to obtain financing. So MTY needs to generate above this in profit each year in order to add value to its investors. And if it doesn't do that, eventually it'll go bankrupt. But this is their WACC. This is the weighted average cost of capital, which is a blend of equity and debt. And that's what we're going to discount the future cash flows by. So we estimated the future cash flows in the next 4 years. Then we did a terminal value, which is the future after 4 years. And the way we do that is using the Gordon growth model or the dividend discount model. And then we discounted those cash flows back to today's dollars. So we get a value of the company of $1.5 billion. And at 25 million shares, we calculate the stock price at $59, even though it's trading at 25. So we consider this a buy. It's trading at a 58% discount. And let's look at historical. That's really interesting to see that right before Corona, it was trading at intrinsic value. Then it dropped like a rock, like everything else. And now it's trading half of intrinsic value. But stock can trade higher or lower than what it's worth. The price is predicated on supply and demand of the market. The more people that want to buy the stock, the higher the price is. The more people that want to sell, the lower the price is until they find the right point. So you have to, as your job, to figure out the future. Is it worth 25 in the future or 59 in the future? That depends on a lot of factors, of course. So if you do research, some analysts will say buy this stock, others will say sell this stock, but each analyst uses their own model and their own assumptions. But you never actually see their model. This is my model and my opinion. Thanks for watching.